Welcome to the drawing board. Today we're talking about systemically important institutions, a term that's all over the news these days. If this deep and prolonged recession has taught us anything, it's that some institutions are so big or interconnected or unique that they pose a risk to taking down the entire financial system if they should fail. So, if we could identify these institutions and then understand and mitigate the risks they present, we might be able to avoid the next big financial meltdown. That's the goal anyway. Now, the first trick is to determine just what makes an institution systemically important. And we've broken it down into four categories, the four C's we'll call them: contagion, correlation, concentration, and context. Let's start with contagion. This is the too connected to fail syndrome. If you think of contagion the way you think of a cold virus, it's a pretty good analogy. Say you're sick and you go to work, and then you come home to your family, and then you maybe go out and catch a ball game and a late dinner. All of the people you come in contact with, your coworkers, your family, the people at the ball game and at the restaurant sitting around you, they might all get sick because of their connection to you. Well, it's the same on an economic scale. Something bad happens to an institution. It catches the equivalent of a really potent virus, and it becomes so sick that it doesn't look like it's going to make it. Now, that's obviously bad for the institution, but if the institution is connected to a lot of other institutions and firms, they might all get pulled down. Now, the firms might be connected in all sorts of ways. They could have loans or deposits with each other, or they might have insurance contracts with each other, or certain trading agreements or cash flow agreements. Anyway, lots of ways these firms might be connected. And while the system might be able to absorb the shock of one institution going under, even a big and important institution, it might not be able to absorb a whole bunch of institutions being dragged down at the same time. Okay, next is correlation. That's our second C. This is the too many to fail syndrome. What happens here is firms look around, almost like kids in school, and they see a whole bunch of their peers doing something they're pretty sure is risky, say getting into mortgage-backed securities in a big way. What they decide, though, is that if everyone's doing this risky thing, there's no way the people regulating affairs are going to let any one institution fail. Because if one institution fails, every institution like it would also fail, and that could lead to a disaster that regulators would likely step in to prevent. They would come in and bail everyone out, regardless of the poor decisions they all made. All right, next on our list of the four C's is concentration. This is the dominant essential player syndrome. If a firm in a critical market or activity accounts for a high percentage of the business or volume of transactions, this too could make the firm systemically important. AIG is a perfect example. Now, AIG was large, but it wasn't its sheer size that made it so dangerous. It was because of its dominance in the credit default swaps or credit derivatives market. Now, AIG accounted for a large volume of credit default swaps, which are similar to insurance policies. A quick explanation. We'll go a little bit down the road of credit default swaps for you. Say I owned a bond issued by a company that builds homes. I've got this investment, right? And I want to protect that investment, so I go out in the market and I find someone who will sell me an insurance policy on that bond. My fear is the company may go bad and they won't be able to pay out on my bond. So the insurer that I take this policy out with agrees to pay the value of the bond if the housing company gets in trouble and can't make good on paying its obligations. In return, I pay this insurer a premium every month, the same way you'd pay your car insurance premium, for example. Well, in this scenario, if AIG were to fail, and they were the ones writing a bunch of these insurance policies, the whole market could be affected because so much of the market goes through them. Our final C is context. This is the conditions matter syndrome. Now, let's say the market was doing great at the time Bear Stearns was having trouble. The market's humming along. No one's really nervous about the overall conditions. And then there's this one firm, a really big and important firm, that starts to look like it's not going to make it. Well, if people aren't all that fearful that consequences will happen as a result of Bear Stearns failing, well, things might not be shaken up too much, and Bear Stearns going down might not be a huge event. But let's say the market were already jittery, as it was, we know. If other firms were failing and institutions were thinking of pulling their money out of the market, the failure of Bear Stearns could be a bigger problem. People might start to view the situation as emblematic. They might say, well, it's a sign of worse things to come, or that underlying conditions in the marketplace are eroding. So the conditions in this case could influence whether a particular institution is deemed systemically important. Now, adding to the problem is that in normal times, it's hard to predict how institutions will react in a given situation. They all might be doing their own thing and acting in different ways. But when something bad happens in the economy, they might all line up and react in the very same way, which could constitute a risk. Even using these guidelines, the 4 C's, it's not easy to tell whether a particular institution is systemically important. And complicating matters further, some institutions may be more systemically important than others. This is why a researcher at the Federal Reserve Bank of Cleveland is proposing a 3-tiered system for categorizing systemically important institutions. Starting at the top, Tier 1 would include high-risk institutions, those that pose the greatest risk to the system if they were to fail. These would be large, highly complex institutions such as large interstate banks or large multi-state insurance companies, and they'd be under the most stringent requirements. Regulators would keep a close watch on their businesses, and there would be strict reporting guidelines. They'd have to undergo regular stress tests. Requirements would also be established that would encourage markets to discipline these firms if they engage in practices that contribute to systemic risk. They might also have to maintain certain capital ratios to make sure they have enough cash on hand to absorb stresses on their business. They might also be required to make sure executive compensation is appropriately aligned with the long-term viability of the firm and the safety and soundness of the financial system. All right, moving on to Tier 2. These would include moderately complex financial institutions that may create some systemic risk based on how connected they are, or their involvement in certain critical market activities, or how their condition may be affected by stress in the economy. Large regional banks and insurance companies would be examples. They'd undergo periodic stress tests and have additional reporting requirements, plus more rigorous supervision. They might be required to develop contingency plans to address what they'd do if they didn't have enough cash flow to pay their obligations. There might also be limitations on what they can have in their portfolio and some additional requirements for how much money they need to set aside for emergencies. They might also have certain limits on exposure to counterparties. In other words, they might be limited in their ability to connect to certain institutions, or they might be limited in how deeply connected they can become. The third and final tier would include non-complex financial institutions. These institutions, community banks for example, would fall outside the systemic institution watchdogs because of the low probability that a failure or stress would cause any widespread ripples throughout the financial system. The goal of this 3-tiered system is to address the root problems that threw us into the financial turmoil that we're in so deep right now, and so we don't repeat our mistakes. But it's also a way to match the level of oversight and regulation appropriately to the risk of different kinds of institutions. We don't want to overreact and overregulate to the point where we stifle growth and constrain the market. While there's no guarantee any of this will prevent the next crisis, if we level the playing field for financial institutions and minimize the advantages of being systemically important, we believe it'll lead to a stronger, more stable market that will serve all of us better in the future. Think about that. Until the next time on the drawing board.